Hey, everybody. Welcome to Wednesday. Yes, we're almost halfway done with the week. And Molly's out today, so I'll be doing a solo dolo. I'm going to do a bunch of crypto news at the top and then some Ask Jasons at the bottom. Crypto firm Voyager Digital, as you may have heard, last night filed for bankruptcy. This is on top of crypto loan company Celsius being in the news again today. They paid back almost $150 million to a decentralized lending platform Maker. That released $40 million worth of Bitcoin as they posted collateral, and all these shell games and loans are starting to get worked out as crypto has collapsed. So we're seeing a massive shakeout and chaos continuing in the crypto space. We'll talk a little bit about why this is all happening and then my predictions of where it winds up. And then I'm going to answer questions from our Twitter community, which lives at thisweekinstartups.com/TC. That'll give you a link there. And I'll take some live from the audience at youtube.com/thisweekin. It's going to be a great show. Stick with us.
This Week in Startups is brought to you by Embroker. Embroker's startup insurance program helps startups secure the most important types of insurance at a lower cost and with less hassle. Save up to 20% off of traditional insurance today at embroker.com/twist. While you're there, get an extra 10% off using offer code TWIST. Thorne. Thorne empowers people to take control of their long-term well-being with a proactive science-based approach to health. Through a variety of at-home tests, Thorne teaches you about what your body needs and provides the right high-quality, certified nutritional supplements for you. To get started and take 10% off your first order, head to thorne.com/u/twist. And Indochino. Indochino makes custom-fitted suits, shirts, and casual wear at affordable prices. Shop for your next best look or book a virtual style consultation at Indochino.com. Right now, you can get $50 off any purchase of $3.99 or more by using code TWIST at checkout.
All right, Voyager Digital filed for Chapter 11 bankruptcy last night. Voyager follows 3AC as the second major crypto firm to file for bankruptcy over the past couple of weeks. If you remember, Voyager has two businesses, essentially. They are an exchange, just like Coinbase or others, where consumers can buy and sell crypto. And then two, they had a lending business where they offered really high interest rates and this easy access to loans for crypto holders. So you could loan out your Bitcoin or take margin against it, I suppose. 3AC was a crypto hedge fund. So they were making trades to try to get returns for their investors. And they were placing bets on, really speculative, crazy stuff like Luna, which was a stable coin known as Luna Terra. And that algorithmic stablecoin, as you know, basically blew up. It went to zero. So you have 3AC, the crypto hedge fund. Voyager had loaned money to them. And the whole thing has now become what we call in the industry a contagion. So 3AC also borrowed money from the lender BlockFi, and they weren't able to meet a margin call on their loans. This stuff is really confusing because we don't have total clarity on it. But when there is a bankruptcy proceeding or there are lawsuits, this is something we'll learn for people who are going through a downturn, a market collapse for the first time. This is my third major one. Dot-com boom and the 2008 crisis were the other two for me, at least as a professional. I missed the 87-88 one. That's when I graduated high school in 1988. But I did see it as a young adult, and it was pretty gnarly, the financial collapse in 88. So back to Voyager. They estimate in this filing that they have over 100,000 creditors. Who are those creditors? It's going to be a lot of civilians who are trading crypto on the platform. They also state they have between $1 billion and $10 billion assets and $1 billion to $10 billion in liabilities. This is a big, wide swath and a range of what's going on in the company. So in a downturn, things that go bankrupt have to essentially go in front of a judge and work out this bankruptcy, which means the kimono opens and we see everything. And we really basically do a post-mortem on what happened. If the company completely fails, there'll be lawsuits in all likelihood, and there'll be lawsuits all over the crypto space. That's the next shoe to drop. And there'll be actions from attorney generals, the Department of Justice, the SEC, and then all the information comes out. This is a very slow, painful process, and it's just starting. I would say we're in the second or third inning of this pain and this assessment of exactly what happened in crypto. So if you dig through Voyager's financials like economic blogger Francis Coppola did, he found that almost 50% of Voyager's total assets are loaned crypto assets, right? So of the assets on Voyager's books, a bunch of crypto assets that have been loaned. And 3AC, the company, the hedge fund that had gone bankrupt, made up 58% of its loan book, according to Francis Coppola. So they obviously gave a firm, a counterparty, and we're going to learn about counterparty risk today. And a lot of people are waking up to understanding that there is another person on the other side of these loans, and they may not fulfill their obligation. This is where things get dangerous. There is no regulation. There's no DNA or scar tissue or lessons in crypto yet. They're all being formed now. And so the lessons about counterparty risk are very real. Of course, you understand them from other things that have happened in history, and we'll get into that in a minute. So if you are holding crypto in Voyager, I am going to guess you're going to lose most or all of your money. That's just a guess on my part. Usually when these things come apart, there's very little left over for the actual shareholders. I could be wrong. Who knows what's in these assets? Again, they listed between $1 billion and $10 billion assets and $1 billion and $10 billion in liabilities. Voyager CEO Stephen Ehrlich tweeted the following to that question of like, what does it mean for people holding their crypto on Voyager? And if they don't have their keys, they don't own their cheese, right? If in crypto, the whole idea was you would own the keys to your crypto. If you own the keys to your crypto, and they're on your wallet or you've got them in cold storage or wherever you're hosting them, this can't happen to you. But people went for ease of use. I have some Dogecoin on my Robinhood account. I don't have the keys to that. They're the custodians of it. If something happens to them and they're holding it for you, things can go wrong. That's what's happening to the Voyager bag holders, essentially. So here's what Steven said. Customers with crypto in their account or accounts will receive in exchange a combination of the crypto in their account or accounts, proceeds from the 3AC recovery, common shares in the newly reorganized company, and Voyager tokens. So working backwards, Voyager tokens, that sounds like they're giving you like mileage points. Chuck E. Cheese tokens, I guess they'll probably be worthless is what I would think. That's not the actual crypto you bought and you made the decision to buy. They're going to give you common shares in the new company. So I guess this means they think they're going to be short giving you back your crypto. And instead of just giving you back your crypto, they're going to give you some proceeds from the 3AC recovery. I would assume those will be cash. And then they're going to give you shares in their company. This would be as if Coinbase went out of business, and that's highly unlikely for Coinbase to go out of business. They got a lot of cash. But if they did, and then they said, hey, you know what? How about some shares of the company instead? Really weird turn of events. Now, remember, Sam Bankman-Fried, who is going to come on the program later this week or next week, the crypto billionaire, he's been backstopping and buying failing crypto exchanges from, and this is from Reuters. Bankman-Fried's crypto trading firm, Alameda Research, gave crypto lender Voyager Digital a $200 million cash and stablecoin revolving credit facility and a facility of Bitcoin as the company faced losses from exposure to crypto hedge fund 3 Arrows Capital. That's the 3AC I've been referring to. 3AC AC stands for 3 Arrows Capital. So a complete disaster. And then just as we were getting on air, I noticed in the 3AC filing, a couple of my friends of mine were kind of digging through it. And they have on their loans, if you look at this image, you'll see that there is a certain amount of money loaned from Voyager to Alameda. So Sam is giving a loan to the company that gave him a loan, if I'm understanding this correctly. Again, it's hard to know exactly what's going on here. But in the data, they say Alameda Research Limited, I'm assuming that's Sam Bankman-Fried's firm, has a borrowing rate of 1% to 11.5% on $376 million in loans. 3 Arrows Capital had $654 million. And you can see that in the chart here in their bankruptcy filing. So there's a lot to unpack here about what's going on. I'm not saying there's anything nefarious going on, of course. It's quite possible that companies were doing business with each other and Voyager gave a loan to Alameda, or Sam personally is backstopping Voyager with his own money. He has talked about doing it with his own money. But this does all mean that there's going to be a lot to sort out. Somebody's going to have to figure out what's going on here. Yeah, this is on page 12 of their filing. We'll put the filing, the Voyager bankruptcy filing, in the show notes. I'm going to be very quick today. You need to understand what cyber insurance is. Obviously, this covers hacks, which happen more than you think, especially in these crazy times. You want to be protected, so you want to have your cyber insurance set up. If you don't have business insurance, you failed one of the first steps of being a founder and having investors. You need to protect yourself. You need to protect the downside. And startups should look no further than Embroker. Embroker's technology saves you time and money. Prices are up to 20% lower with better coverage than incumbents. Go from sign up to quote and purchase in just 10 minutes. When you work with Embroker instead of the big incumbents, you're not dealing with these large, slow corporations. And sign up with Embroker takes days, not weeks. The process is totally transparent. There's no opaque pricing. There's no annoying incumbents standing in your way of just GSDing. You got to get stuff done, okay? And let's face it, these slow incumbents, they're not going to get it done, okay? So to instantly buy custom-built insurance for startups, go to embroker.com/twist, embroker.com/twist. And while you're there, you're going to get an extra 10% off, I kid you not, by using my code, TWIST, T-W-I-S-T. All right, moving on. Celsius just unlocked 2,000 wrapped Bitcoin. That's about 40 million worth. And they did this by paying down some of their debt. Again, people had Bitcoins. They had taken loans against them. You could call these margin loans, is what most people would commonly refer to them. So a quick explainer if you don't know what WBTC is. Wrapped Bitcoin, very simply, you take a Bitcoin and you wrap it on the Ethereum network as a token, and then you can trade. Well, why would you do that? Why don't you just trade the Bitcoin on the Bitcoin blockchain? Well, Ethereum is faster and it's cheaper. So clever idea, right? So you might remember Celsius was the first major crypto player to pause withdrawals on June 12th and transactions on their platform when the 3AC hedge fund collapsed. So they had exposure as well as Voyager. Celsius has not resumed service to its 1.7 million users almost a month later. So as of May 2022, the firm had lent out more than $8 billion to clients, and it had $12 billion in assets under management. Since pausing on June 12th, and it was, again, very hard to understand what's going on. There's not a lot of transparency. There's not a lot of filing going on here. There's not a lot of disclosures or regulation in this space. And we talked for years, hey, if you want to play in crypto, you're playing in an unregulated casino. You're playing a very dangerous game with very sophisticated players, and it's not transparent. That means you don't have an information edge. You're at an information disadvantage. And, some people might be doing corrupt, criminal, fraudulent things, and you might have a hard time knowing about it. And so as we watch this contagion happen, what you'll find out is who was doing things that were either highly risky or illegal. And there's going to be a wide range in there. And there'll be a debate of, was any of this illegal or just stupid or high risk? And, people in crypto wanted outsized returns. So up and down the stack of people participating, from civilians, retail investors, people who were bus drivers or Uber drivers or teachers or doctors, everybody was wanting to get in on this. They were having high pressure on them. Hey, have fun staying poor. They were, had the FOMO of NFTs. And so they just opened up accounts and started participating without really knowing what they were getting into, right? And so they are responsible for their behavior, but then up the stack, you're going to have other people responsible for maybe creating the environment in which people made these bets. And this is going to be the mess of all messes to clean up. So since pausing on June 12th, so they've been basically closed for close to a month. Celsius has hired restructuring consultants. They laid off 150 employees, and regulators have opened investigations into the company. In other words, not good. Red flags all over the place. But according to CoinDesk's analysis, Celsius has paid down $183 million of its collateralized debt to a decentralized lending platform called Maker. So, okay, here's another counterparty who is lending them money and lending money in the space. The debt payments released 2,000 wrapped Bitcoin. We talked about those before, which is 40 million worth. Celsius posted that as collateral. Now Celsius still owes 41 million to Maker, but if they repay those loans, that would unlock 22,000 more wrapped Bitcoins, which at today's price is worth well over 400 million. So the bottom line here is there's something called counterparty risk, and it's a pretty basic term. It basically is the probability that in a transaction that the other party will not fulfill its part of the deal, or they'll default on their contractual obligations. So in a loan, the person who takes the money doesn't pay it back. This could be a credit card. It could be your home. It could be a business loan. How do we deal with counterparty risk, right? We want to be able to loan people money to do productive things in the world. Well, traditionally, it's information-based, right? Your credit score determines what size loan you can take out, the terms of the loan. Also for your credit cards, you might have a credit history score, and they'll look at your history. Hey, have you defaulted on your Verizon payments in the past? I had that. I didn't know I had a phone number. I had some Verizon stuff on my reports. I had to go get that cleaned up. These little things happen in life. And it's usually based on information. Well, in a hot market, people loosen their standards. They get loosey-goosey and they want to make money. So if you want to make money, you might turn a blind eye. What's an example of this? Well, you remember the housing boom. For those of you who were around in 2008, you might have had a friend who was making $50,000 or $60,000 a year and they bought $1 million home. And you say, well, how's that possible? The payment on that home is going to be $5,000, $6,000 a month, and you make $50,000 a year, and you've got $50,000 in loan payments plus, the maintenance of the house and taxes on the house. I don't understand how you bought $1 million house. Well, they were doing loans at that time where they didn't investigate what information they could have, your scores and your savings and your salaries. They basically would just not vet you. Well, then what happened? The 2008 financial crisis, because people were buying these homes and then they would flip them. So they'd never have to worry about it. And if a house was going up 15% year over year, if you bought it for $1 million, you could sell it next year for $1.15 million. And that's essentially how the housing financial crisis happened in 2008. They basically took the last 5 or 10% of people in society who were not credit worthy of buying a home. In other words, they didn't just have the income to pay for those loans, and they let them buy homes. And this is when things get dangerous. There are people who have tons of assets. If you're, a billionaire and you've got $1 billion in stock and you want to take, $10 million in loans to buy, $100 million in loans, you have enough collateral there to pay for it, and you maybe have a salary and a history of making money. And if you give these loans to people who don't have a history of making money or collateral, bad things can happen. So crypto was actually supposed to solve this. In DeFi, decentralized finance, this was all supposed to be on smart contracts. And if your Bitcoin went below a certain amount, it would get liquidated. And that's when we saw the cascading of liquidations in Bitcoin, where people were getting liquidated because they took loans against their crypto and they were automatically being liquidated. Well, there's other people who were giving these kind of loans in crypto. And I think that's what we'll see with this whole Mashugana with Voyager and 3AC. They were giving big loans without maybe having it be programmatically paid back. In other words, through a smart contract where it just instantly happened on the blockchain. You covered your loan, and maybe they didn't have the right information. Now, here's another rub. It can get even more dangerous. In that housing bubble, there were people who would maybe get 3 or 4 loans for 3 or 4 homes, and they would lie on the paperwork. And they would say on the paperwork, this is my primary residence, because your primary residence, you get a little bit of a better deal in terms of interest rate, and people want to see you get your primary residence. So there's kind of different standards for that than the second or third home, which would be looked at as income properties, or a second home like a vacation home. You would get different terms on that. Well, now, if you shouldn't have owned the first home, but you did 4 homes, and then you take out loans against the home, so you take out equity lines, so the home goes up in value from $1 million to $1.5 million over 2 or 3 years in a housing boom. You take out $500,000 in a home equity line, and then you put that out as a down payment for 2 other homes, and you try to rinse and repeat this. This was working for people. They were flipping houses. And in that 2005 to 2008 period, there were people who you'd be at dinner. I'd be in Los Angeles, which is a booming market. And I'd say, what do you do? Oh, I flip houses. And it was like literally like people in crypto were flipping NFTs. Well, that's what's going to come out, I believe, is that there'll be a bunch of people who had massive counterparty risk across multiple different loans, and none of them were reconciled with each other. So, the third person you took a loan from didn't know about the first 2 people. Just like in this housing bubble, they didn't know you had those other 2 homes. People lied. Just like when I grew up in Brooklyn, there were loan sharks, there were people who would loan people money, there were bookies who would take your action. People might take action in Bay Ridge, Brooklyn. They might also, place a bet in Queens and one in Manhattan and one in the Bronx from 4 different bookies. And it took a while for their network to let people know, hey, this person went south on $10K in bets on the Jets. This person also went south on $20,000 in bets on the Knicks. And the bookies then would obviously have to let each other know, hey, don't give this person any more action. Don't give them any more loans. That's what we're going to see. My take on all this is everybody knew what they were doing. It's hard to have any sympathy here. It's fine if Sam wants to backstop everybody. That's his choice. But I say let it all burn. Let it all come straight down to zero. There should be no bailouts here. Everybody was an adult. Everybody was greedy. Everybody lowered their standards. Everybody believed that this stuff was going to the moon and it was never going to stop. And they were making bets that were highly volatile. They knew they were volatile and they didn't have basic diversification in their accounts. I mean, I feel bad for the people who lost their money in one way, but I don't feel bad for them in another way, which was they knew this was crazy. All the warning signs were there. Now, there'll be different levels of culpability and different levels in which people are responsible for what happened. If you were actually creating the casino and creating this environment in which people could gamble their money and you were encouraging them to do it, I think we'll see a lot of that happen where maybe people weren't getting good information about how risky this was. Yeah, there could be a bunch of lawsuits, but people knew this was super risky. They were buying tokens. They were buying coins, NFTs, things that they knew didn't have value. They were taking loans to buy more of those things. And, it's you're responsible for your own behavior, period, full stop. And, feel bad for, people who've been hurt. But on the other hand, I think people were taking risks they didn't need to take. I'm curious what you think. I'm at Jason on Twitter. You can mention me and tell me if you think people deserve to lose their money for making these risky bets, or if you have sympathy for them, if you think they should be bailed out. Honestly, I think this is going to be super healthy. 95% of crypto is worthless, never had a use case, never had customers, never had completed projects. The coins were worthless, and it was a pump and dump scam. And the bag holders typically were the consumers. That's all terrible, but this is all going to get flushed out. I see people talking about Bitcoin 5,000, 10,000, and that this is going to be a 2 or 3 year process. And you're probably wondering, well, how did people let this happen? Well, the regulators and the enforcement in the United States, at least, is generally, we trust people to do the right thing. And then if they do the wrong thing, well, then we will take legal action. We'll investigate them. We assume good faith when people are running companies. We're not going into companies and saying, give us all your paperwork and we're going to audit you. I mean, there are some segments of society where audits take place on a regular basis, public companies, et cetera. But generally speaking, in startups, and it's based on trust. And the United States system is innocent until proven guilty. People can go build things, and that's what's great about the economy. We don't want too much regulation, but this is an area where I think people got very frisky. If you were to look at other areas people got frisky, you may look at an Airbnb saying, you know what, we're going to bend the rules and let people rent out their rooms, or we're going to interpret the laws around how many days you can rent your own house or apartment. If you're a renter, can you be on Airbnb? They might have taken an aggressive stance at different points in time. But remember, Airbnb was providing fundamental value. People needed a place to stay. People wanted to make money renting their extra space, and a marketplace was created, and there was actual value going on. Here, you have to ask yourself, was there actual value going on? And the answer is, in 99 out of 100 projects, there was no value. It was pure speculation. It was pure gambling. So it's going to be another, I would say, 12 months of just chaos in crypto. And then we'll see if there's an Amazon or a Google in there. And that's what I'm really looking for. I do think there are real projects in crypto. And I think now companies are going to try to actually delight users with products that actually work and use the Web3 stack, crypto, blockchain, DeFi. And there's going to be so much cynicism about crypto over the next 2 to 3 years that anybody who operates in crypto is got to be a true believer and not a charlatan and not a grifter, because there's not going to be a quick buck to be made. I think it's going to be so highly regulated that people are going to find it painful to be in the crypto space. I think the defaults are going to be never ending. I think the pain and suffering is going to be deep and widespread. And I think the rebuild is going to be 3 to 5 years of rebuilding this space. And then we might actually see something come out of it, which is exactly what happened in the dot-com boom and bust. Listen, dealing with your personal health and wellness, it can be daunting. You're probably being bombarded by ads and blog posts. You have no idea where to start. And that's why Thorne created a care system that's personalized, preventative, and holistic while still being science-based. And if you're a high-performing founder or operator, you need to make sure you take care of your health. And listen, I was out of shape for a long time. Now I'm taking my health very seriously, and you should too. And that's where Thorne can help. Thorne offers at-home tests which identify where you need the most care, like a gut test that analyzes your gut microbiome and a stress test that measures your stress hormone fluctuations. These tests help eliminate the guesswork for good health by providing personalized steps for how you should eat, how to exercise, and what supplements you should take. These are the questions that are on all of our minds. They've got a range of multivitamins and supplements you can subscribe to, and Thorne is totally vertically integrated, so you're not dealing with anybody in the middle. Again, this is personalized health and wellness. To get started and take 10% off your first order, I want you to head to thorne.com/twist. That's thorne.com/u/twist. Thanks for supporting the show, Thorne. Really appreciate it. And thanks for making such an innovative product. Okay, we're going to do some Ask Jason questions. It's the summertime. I could talk about crypto all day long, but you all have questions for me. I would like to get some timely questions and some timeless questions. So if you're watching live right now, go ahead and ask a question. We'll queue you up. We also have a program called Founder University. Founder.University is a 12-week program, and it costs $700. If you come to all 12 weeks, we give you the $700 back. So it's basically a way to incentivize people to come every week. Every week you come, you get back like essentially $50 or $60 of the money you put up. This is a little interesting device we did. This has led to 95% of people finishing the program, which is super awesome. And we're now doing our third cohort. You can go to founder.university to apply. But folks from the program ask me questions all the time, and I'm backed up on some questions. So here's the first one. It's kind of a fun one. Graham Caro asks, would you ever consider applying to Shark Tank as a judge to grow your brand or create your own tech-centered version with the besties? Or are you too old, too tired, and too talented? That last clip is something that the star of, what's the HBO show? Succession. Yeah, the lead actor on that said that at some point when they asked him a question, and it was a pretty funny one. So I actually was approached by the Dragon's Den, which was the precursor to Shark Tank. So it started actually in the UK as Dragon's Den. When they came to the US, Mark Burnett's people called me, they called Mark Cuban, a bunch of other people. And then they went with like people who weren't in tech. Tech wasn't super popular at that point. And then they circled back around with Mark Cuban. And he was actually under investigation at the time, quite unfairly by the SEC for this Mama, which was like a search engine or something. Once he got cleared of all those charges, where they were kind of essentially saying that he was trading on insider information or something like that when he wasn't, he wound up doing it. And then maybe later on, I got contacted actually again, where they were just kind of putting out feelers. But I just am in the process of putting the final deal points on another reality TV contract with another, I'd say, what most people consider the top reality TV production company. And so we're in the final negotiation there. And I had previously done an NBC pilot about the incubator. It was called The Incubator, and it was going to be on NBC. But my partner on that was Harvey Weinstein. And then when all that information came out about Harvey Weinstein, it basically killed the project. So most people don't know that story. But I have dabbled in reality TV. Yeah, this will be the second time, basically. I get contacted every year a couple times, but usually it's for shows that I think are corny. This new deal I'm doing is to develop a show alongside them. I also did on this very channel something called The Syndicate, where I would have a bunch of syndicate investors come together and basically vote with their dollars on companies we were presenting. And so I might do something myself around The Syndicate. And I think reality TV is great if it inspires people to go on and get excited and invest. And in fact, Chamath was on my reality show. He was one of the guest stars, and it never made it to air, but I have the pilot on my phone. I can't show it to anybody because all under NDA and stuff like that. But I do have it on my phone. But I don't think the other besties want to do reality TV. I think it's enough work to just try and get all in out every week. So we're just, as you may have heard with all the controversy, we're just not making All In a commercial enterprise. It's just a weekly podcast with 4 friends. Okay, here's another question from Isabel, again from the Founder.University first cohort. I think we had maybe 95, 100 people went to that first cohort, and I think 85 or 90 graduated. And I invested in maybe 5 of them. So Isabel asks, trying to bootstrap as long as possible, but when is it okay to quit your day job? And so she continues, I was thinking that in this scenario, the best time to raise is when speed is needed to compensate users and profits are scaling. But would it look bad to start raising while working the day job? Great question. So investors are not going to give you money unless you quit your day job, because they want you, and this is going to be like, I'll tell you what they say behind closed doors. I've had situations where people were working at like Google, they had a side project and they're like, you know what? It's a really cool project, but these are cowards. Like literally, this is how venture community looks at the people who will not quit their day job. It's unfair, I know, but I'm just telling you what they think. We have people who are risking it all. They have massive skin in the game and they have burned the boats. In other words, they got to the new world and instead of having the boats there where they could go home, they would burn the boats. And burning the boats, as you probably heard Elizabeth Holmes say, in that TV series about, her time at Theranos, burning the boats as a concept means you're all in. You are walking across that tightrope without a net. And it's that type of pressure that the venture community believes makes the diamonds, right? And if you're hedging, and listen, people have kids, they have families, they have bills to pay. I understand why you wouldn't quit, but you're just not going to raise money. So the best thing to do is to take your day job and eventually make it a consulting gig. And so 9 times out of 10, I think, or 4 times out of 5, if you were really valuable to the company you're at, you could say, hey, listen, I want to pursue this startup. Would it be okay if I went down to 3 days a week as a consultant? Here's my hourly rate. You can take me off the books. I don't need benefits or whatever. I'll use my Cobra for the next 6 months. And you come up with some deal. That actually worked for me and other people in terms of that. Then when you go to folks, you can say, yeah, I'm consulting 2 days a week or 3 days a week, but I'm all in on my startup and I'm just consulting to keep the lights on. Once I raise a little bit of money here or I get the revenue started, then I'm going to even stop doing the highly lucrative consulting. But I'm using that highly lucrative consulting to fund the business. So that's called framing. Framing is how you present a piece of information. And you can present the same piece of information 2 or 3 different ways. If you framed it as, yeah, well, I don't know if this startup's going to work, so I still kept my job. That's one way of framing it. And that's like the worst possible framing. But if you said, I get overpaid to do this consulting because I'm so valuable to the company that I used to work at and they didn't want to let me go. So I basically tripled my rates and I took my hourly rate and I tripled it. And now I work for them, 1/3 of the time, but I get paid the same money. And I'm using their money to fund this startup. Man, now you look baller. Now you look savvy. Now you look in demand. Same information, but presented in a different way could have a majorly different result. So, but bootstrapping is the best thing you can do. Bootstrapping means, it comes from the phrase pulling yourself up by your own bootstraps, which doesn't make a lot of logical sense. But people who are bootstrappers or doing their startup through sweat equity, those are the most attractive founders in the world. Why? Because they didn't wait for permission from investors to get started and build something important in the world. They just did it. And that sense of inevitability in a startup is very attractive. That is like nectar to the honeybees that are venture capitalists. They see that you're going to do this startup come hell or high water. You're going to do it whether you have to be a consultant 3 days a week and do this 4 days a week, and you're just dogged and driven and visionary and you will not stop. Man, now it's like, well, that's the person I want to place the bet on. The person who's like, I'm doing this, on the weekend, that's the person you don't want to place a bet on. In a venture capitalist mind. Not saying it's fair, not saying people don't have different needs in life. And, you could be a single mom or dad with 3 kids in private school. And listen, startups are going to be impossible. There's nobody who's going to fund a startup with 3 idea founders, all who need to take $250K a year. It just very rarely happens in our industry. And it's the nature of venture capitalists and their signaling and what they've seen work before. And the reality that there's not enough money in an early stage startup to pay for the big salaries. Early stage startups need to conserve cash. Most of the founders in early stage startups I see will take a $5K draw a month, $60K a year, sometimes $7 or $8K, $100,000 a year. They'll take just as much money as they need to cover their nut, just cover their mortgage, rent, their food, and they're all in on the equity. So make sure that you're giving the impression that you're all in on your own equity. And if you're not all in, why should somebody take a bet on you when they have other people they can bet on? Remember, it is a competition. So they have other choices of who to invest in. They're going to invest in the person who's all in, not the person who's hedging their bets. Great question, Isabel. Weddings are back in full swing this summer. You know that. You need to look great, whether you're the groom, maybe you're in the wedding party, or you're just a guest and you want to look your best. This is what you need. You need to go to Indochino. They make high-quality, custom-fitted suits, shirts, casual wear, and more. Maybe you're going to the Minions premiere and you need a great suit. I don't know, whatever your bag is. With Indochino, you can customize everything. Suits and shirts, chinos, bomber jackets, and it's at surprisingly affordable prices. This is high-quality stuff at a great price. And you are going to be able to just make every little nuance of your suit your own. Everything. They're going to measure it. It's super easy to get measured. I did it. It was a delightful experience in the store. The person was a delightful person to deal with. And then they walked me through, hey, what fabric do you like? What lapels? What monogram? Maybe some statement linings. All for starting at just $429 a suit. I kid you not. And shirts are only $79. It's an incredible bargain. I love my Indochino suits. I wear them all the time. And if you've got that big day coming up, getting the perfect look is simple with Indochino. $50 off any purchase of $3.99 or more by using the promo code TWIST at Indochino.com. Indochino.com. Use that promo code TWIST so they know I sent you. Okay, should we take one from the audience? Do you have a good one from the audience so we can keep the audience engaged? All right. EVVE asks, when a company you already invested in comes back asking for more money, how do you decide whether or not to double down? What a great question. So we are very clear with our founders. We like to get to a 10 to 15% ownership position in growing companies in our portfolio. If the company is growing, and growing is typically double-digit percentages month over month. If you're growing 10% a month, that means every 7 months, the rule of 72, look it up. When you grow 10% a month, you will double your revenue or users, whatever you're counting, every 7 months. And you really, in the early stages of startup, you're looking for tripling your revenue every year for the first 3 years. So you started with $150K in revenue, you got to $450, then you got to 1.4, 1.5 million. That's a high growth startup. Very easy for me as an investor and the syndicate, which is a group of 11,000 angel investors making their own independent decisions to invest on average $7,000. I think $6,000 or $7,000 is their bet, and our average deal I think is $750K to $1 million at thesyndicate.com. So I'll invest a little bit from my fund and then from the syndicate. If you're not growing, the syndicate doesn't perform. The syndicate doesn't want to invest in things that are sideways. So what we do is we invest in a bunch of companies, say 50 new companies a year, and then some number of them hit that goal. If we see you hitting that goal, you're tripling your revenue year over year, we will then invest more money until we get to that 15% ownership position. Once we hit the 15% ownership position, if you continue to grow, we will take our pro-rata, which is a legal term. It's a right for investors to maintain their ownership percentage. So if I own 15% of your company, now you're worth $500 million, and you decide you're going to raise $50 million. Okay, I need to come up with 15% of $50 million to maintain my 15% ownership position, which means I got to come up with $7.5 million. We actually had this happen with the unicorn. We own 6% of it. It was $1 billion company. They were raising $100 million, and the syndicate did its largest deal ever and put in $6 million. So we actually got to put $6 million into a company that we had invested in when it was only worth $4 million. So we really love to keep investing in growing companies. Now, what if a company is not growing? Well, you are then, as a founder, it's up to you to go find new investors. You cannot, as an investor, keep becoming the sole source of funding. So you have to understand, as a founder, you get money from a group of angel investors. They typically only invest once. Some of them, maybe 10, 20%, will double down, triple down on winners, but they're not going to double down and triple down on sideways companies. So then you have to then sell your story to another group of investors. The other qualities we look for, and so generally we don't do bridge fundings. We like when a round is priced. What does it mean for a round to be priced? That means a new investor came in and said, you know what? JCal invested when it was a $10 million company, and he put $1 million in and bought 10% of the company. The company tripled its revenue. We now think it's worth $30 million. We want to put in $5 million. We want to own approximately, 15% of the company. Well, depending on that lead investor now has done the work for the entire investment community to mark your share price up. You've proven to the market that you can find another person who wants to buy your shares. If you can't prove that, then maybe your company is not increased in value and you need to do what's called a flat round, which means you take that $10 million and you say, hey, anybody want to put another $500K in? That's a bridge, okay? Or sometimes they'll call it seed plus. And that's the hard truth about Silicon Valley. It is a milestone-based funding system at its best. And so what that means is you have to perform. And if you perform, you get more money. If you don't perform, you may not get more money. Or you may have to convince another group of people to take a flyer on you. Or you may only be able to raise at your last valuation and do a flat round. So those are the hard truths about our industry. And for me, I communicate that as honestly as I can with founders. And sometimes they do not take the news well. I've had founders say like, I don't understand, you believed in us. And I said, okay, but we are not a charity. We have to have a betting strategy in order for us to raise our next fund. We never intend to invest in 50 companies in a fund and then keep investing in all 50. We intend to invest in 50 very high risk companies and then invest in 10 of them more money. In other words, the top 20% will get more money from us. That then lets our portfolio shine. We're putting more money into the most high performing companies as opposed, to other times when you're just not performing. And, there's a lot of reasons why you didn't perform. It could be bad luck. It could be a competitor. It could be your own execution. It could be there's not a big market there. And then the healthy part of that discussion is when the venture community will not fund a startup, that founder then has to either prove it to the venture community through revenue growth, which means they cut their staff, they find customers, they do a consulting gig to keep the company going, whatever it is, or they shut the company down. People take the loss. So, okay, we lost $1 million, but we made 10 million here. We take the 1 million loss against the 10 million gains. And that's part of the game as well for investors is they can take those losses and put them against gains. And that's the beautiful part about capitalism in the United States. This is not an industry where everybody's supposed to win. It's not participation trophies. Sorry, not everybody's supposed to win. There's supposed to be a small handful of winners. If your company doesn't win, we kind of want you to shut it down and start a new one and then have a fresh cap table with a new vision and move on. And that's a very hard discussion to have. And it typically happens when the money runs out. And it's now I am very philosophical about it. It didn't work out. You did your best. Go work at Facebook for 2 or 3 years. If you have personal debts, pay them down. Recollect your energy, rest, invest on the roof of Huli or Google or whoever wants to give you an overpaid job. And then when you have your next best idea, come back to the venture capitalists and to the angel investors and to the incubators and take their money again. I hope that answers your question. Okay, let's take one more from the audience. Great job, Rachel. That's a great question. Okay, Kumar asks, I'm about to raise a seed round. Congratulations, Kumar. Funding has been arranged. I don't know what that means. Just need to finalize the paperwork. Should growth be the target, increasing the user base, or generating positive cash flow? Great question. Okay, I'm going to assume you're going to wrap up your funding, and then you're saying, hey, once I have the funding, should I be growing the user base or making money? Okay, this is highly dependent on the market you're operating in. In the high growth boom days of the last 5 years, most people would say, don't worry about revenue as much as the user growth, especially if you're in a consumer startup. In other words, Instagram, YouTube, Twitter, you just want to get a large number of people. And then once you have tens of millions of people, then you turn on advertising. Turning on advertising with 100,000 people, it generally is going to have moderate results. And you're going to be serving two masters, the advertisers and the users. So it's better to just go after the users. If you look at the All In podcast, there's no advertising on it. And that actually became a big feature. And now it's very big. And now we're forced to say with All In, hey, maybe we should add some ads, or people are offering us very large sums of money. I mean, we decided not to. But even this week in startups, we started having advertising in the early days. We just did it because people were asking. And slowly over time, we were able to raise the rates, et cetera. It depends on what market you're in. And it also depends on the market you're operating in. So if you're a B2B SaaS company or you're a marketplace, why wouldn't you take the transactions? It's kind of built into the system. If you're Uber, why wouldn't you take your 25%? If you're Airbnb, why wouldn't you take your 10 or 15%? You should take it. You don't want to train the customers to not do that. So if you're a consumer product, I could understand putting it off. But if you're a B2B marketplace, SaaS company, why would you not charge for your product? If you charge for your product, you get better feedback. And the number one piece of feedback you get is your product worth paying for? You need to know that as a founder. If you put that off as a SaaS company, it's a really dumb decision because now you never know if people will pay for Slack. But Slack was never free. You always had to pay. Now, they may have free versions, but if you wanted their top tier, you had to pay. That gives signal back to your team. So there's the vertical you're operating in your business model. There's also the market conditions. In a market like today's, where the market is down, people don't want to invest in money-losing startups that have no path to profitability or no path to break even. Whereas just 6 months, 12 months ago, they did. So the market has changed. I would say if you're not an advertising-based company, I would try to turn the revenue on. And think about it this way. If you're burning $50K a month, and all of a sudden you get $25K in revenue, now your burn goes down and your runway doubles. So your burn went down by half, which means your runway doubled. If you had, $500K in the bank, you had 10 months of runway. Now you make $25K a month. Now you've got 20 months of runway. That's a big competitive advantage. And that means you're getting close to, as Paul Graham would say, default alive. Default alive means you're break even or profitable. So in this kind of market conditions, where it's going to be hard to raise money and money's going to be expensive, I would, certainly try to turn on revenue if you can. Okay, let's take another one from the audience. All right, Bob G, OG Bob G. What current FAANG CEOs would you like to interview? What insights would you look for? It's really interesting. Sundar and Satya are incredibly boring, and they just really don't talk too much about controversial stuff and visionary stuff. When you're a hired CEO of a company, as opposed to the founder, you've got to be careful because you're a hired gun. You report to the board. And so doing an interview, they tend to stay on message and they don't have that founder authority to be bold and crazy and honest. So Zuckerberg would be a really interesting one. I would totally interview Zuckerberg. I'd love to get why he made certain decisions. We interviewed Elon at the All In Summit. He's amazing, right? He's super honest. So there's that founder authority. So I would love to do Reed Hastings from Netflix. Oh my God, that'd be great. I've asked him a couple of times. I don't think he even knows who I am. And he could care less. I've seen Reed Hastings a couple of times give interviews. He's a really good interview. I'd love to interview him. I'd love to interview Zuck. That'd be interesting, especially since I've been such a long-term critic. Google, I did interview Sergey when it was like year one of Google. I got to find the tape of that in like 2000. I guess for Amazon, Jeff Bezos would be an all-time great interview for sure. I'd love to do that, but I'm not sure the current CEO, again, might fall into the bucket of being on message and maybe reluctant to say anything too bold in an interview. So, but I would interview any of them, of course. And the insights I'd be looking for, I would really like to talk to Reed Hastings about their philosophy around original content, because they really have done some great niche content. They stood behind Dave Chappelle. They stood behind Ricky Gervais in certain controversies. So I'd love to talk about that. Like, how do you deal with comedy? It's like such an incredible draw to the platform. But some people are triggered by, certain topics in comedy, and comedy at its best is pushing the envelope and challenging people. So that would be a great discussion. And then how do they compete when there's so many different people trying to do what they're doing at Netflix and they're up against that? So Disney and HBO Max, how do they deal with the competition? I would also like to ask Reed Hastings about dropping the whole season versus releasing each week, which is the better idea. I think we saw with Obi-Wan and some other series, if you let them breathe, Apple TV letting it breathe with Severance, you kind of get this buildup and you have this like nice thing to talk about every week with your friends. Did you see the latest episode? Like The Sopranos kind of burned in all of our minds. So yeah, I would love to talk to Reed. I guess it seems like Reed Hastings would be the most interesting at this point in time. And that's what I would say. Okay, let's take another question. Pre and post money. Great. Okay. So let's say, this is from somebody named Bill McCabe, pre and post money. If you value a company at $8 million, and then you're going to invest $2 million in the company, the pre-money valuation before the money went in was $8 million, you determined. Now you give them $2 million. Well, now the $8 million enterprise value of the company is a company that's still worth $8 million, but they have $2 million in cash. So 8 plus 2 equals 10, post money. It's really that simple. So before we give you the money, and then after we give you the money. And then you obviously can calculate the number of shares that were given, et cetera, to understand ownership percentage. Okay, let's take one more question. I'm in a zone right now. Give me another question. Do you entertain pro-rata multiples or not? We ask for 2 to 3 on most deals. I think what Brandon is talking about here is, hey, can I, if I put in a small check, let's say $100K at a $10 million valuation, I own 1%. In the next round, because I'm taking the risk early, can I put in $500K? And so somebody check with Brandon if that's what he's talking about. So in the next round, can I buy up to 5% of the company? So I have one, and I think most people would call this super pro-rata, or pro-rata multiple would be another way to say it. I've never heard it said like that. I call it super pro-rata. That's what I've always heard. This is a controversial right. We actually have it from our accelerator. So when people graduate from our accelerator, we have the right to put $500K or do half the round, because we have the syndicate. So part of the value proposition of coming to the launch accelerator is, if you do a reasonable job, we're going to, in all likelihood, syndicate you. I think we do this 5 or 6 out of 7 times. Jackie, who runs the program, can tell me. Sometimes the reason we don't do it is because they don't raise another round of funding in the 6 months after they're doing so well, or they don't want to raise money. And so that can be controversial for the next set of investors who are trying to slurp up as much equity as possible. So if you give that right, make sure it's with somebody who you really want to own a large percentage of your company. And it typically happens when things are small. The problem with this right is, how do you execute it when you do the next round if it is a big right? So if the person is putting in 5%, let's say they put $500K in a $10 million valuation company, they own 5%. Now let's say they say, I want to be able to put $3 million in the next round. Well, let's say the next round is $3 million. Well, then how do you do that? They have the entirety of the next round. If the next round is 15% of the company and they get to put $3 million in, somebody gave you a term sheet, they get to steal that term sheet out from under them. So it really is the scale of it. I think if it's really tiny and you're saying, hey, I own 1%, I want to go to 3, or I own 2%, I want to go to 5, I don't see much of a problem there. If it was, hey, I own 5%, I want to go to 20% guaranteed or 15% guaranteed, that could screw up the entire round. There's no room for a new investor. So you just have to be careful. Consult with an attorney, obviously, in these cases. If you don't need to give that right and you're oversubscribed, then don't give it. If you're a venture firm in your seed stage, I like the idea of you going for it, Brandon. I like it. I think it's a clever idea. And for the founders, if you got early support and the person said, hey, listen, it will really help me if in the next round I can increase my ownership percentage. Can you just give me 72 hours to give you a yes or no? It's very little skin off your back. And you can just say to the new investors, listen, Brandon or J. Cal gave me a ton of support. They own 2% of the company. I told them they could go up to 4% in this round. I'm going to, live up to that obligation because we wouldn't have gotten here if it wasn't for them. So if that's what he's talking about.
Yes, he said that that's what he was talking about.
Perfect. Thank you. All right. I'll take one more since we're doing so good with these questions. These are great questions, everybody. Wow. Oh, it's from Bob G. Hey, Jason, I am a marketing intern. What marketing strategies do you advise companies to avoid? And which do you personally like most? Okay. So the most important thing with any marketing strategy is that you're iterating on it and you're taking an iterative approach. What do I mean by this? Well, you're kind of testing it. So as but one example, Inside.com, the other company I run, in addition to This Week in Startups and launched a job board. So I said, I think it'd be pretty interesting if we mix the news at inside.com/crypto or inside.com/AI with jobs and questions. So I just had this vision. What if like LinkedIn, Quora, Reddit, and a job board had a baby? What would that look like? That's Inside, and it's by topic. So really interesting, right? Inside.com/real estate or RE could have real estate jobs, could have questions about real estate, the industry I'm talking about, and news stories. Kind of an interesting, potpourri of items. So I told my team when we launched this 2 weeks, let's try a couple different strategies. One of them is we're emailing people directly and saying, hey, you're an HR manager at this startup. You can post your jobs for crypto here free. And so I just asked people, hey, can you just email 10 people a day and report back to me what happens? And after you get to 100, tell me how many of them replied to you and how many of them clicked the link and how many went there. So the best marketing are when you would look at that and say, hey, we emailed 100 people who were in HR and 2 of them posted a job, 2% response rate, and 10 of them hit reply. Okay, that's one strategy. I took another strategy where I told them, hey, go and find really interesting jobs that relate to Disney, because we have a Disney topic, or relate to NFTs, and post those jobs ourselves. So we would post the jobs on behalf of the companies. And then the next thing I'll try is email them and say, hey, we posted your job over here because we thought it was interesting. So if you think about it like a news story, you could post to Reddit a news story or to Hacker News, but you can also post a job. Well, why does the person posting the job have to be the person who worked there? So I'm trying 3 or 4 different marketing strategies and then iterating on each one, and we'll drop some that don't work. So it's really the philosophy at which you go forward with this. PR is another one. Some people just give $25K to a PR firm and they don't get any response. A better thing might be to say, you know what? I'm going to hire a great writer to work with our founder and CEO. And I'm going to have that writer, I'm going to pay them $2,000 for each blog post they write. And I'm going to ask them to write 2 blog posts a week. So we're going to spend $100,000 a year. We'll have 3 different writers. We'll write 100 of these. And then for $100,000, we'll have all this great, is that right? No, $200,000. It was $2K. Let's say it's $1,000 a blog post. That would be more realistic. So 2 a week, $2,000, 52 weeks a year, 104,000. You take 2 weeks off, 100,000. That 100,000 versus 300,000 for a PR firm. I bet you the $100,000 spent on 100 articles at $1,000 each would do better than the PR if you picked great topics. So there's like a really good debate you can have internally. Hey, if we want to get press, how are other people getting press? Are they getting a PR person to email me? When a PR person emails me and says, I want to have my person on This Week in Startups, I have a canned response that says, oh my God, thank you so much for thinking of us. There's like a really nice, piece of bread. And then I say, but we don't take any pitches for the podcast. Can you please can you please note this in your database? And please do not offer us any more clients. Thank you so much. Then, that's the ish in the middle of the sandwich. And then a really nice, oh my God, thanks again for thinking of us. And then people are like, okay, thanks. But how do people get on your podcast? And we say, we select them. That's it. So just so you know, like PR firms don't work for getting people on the really good podcasts. What works? You having a really interesting opinion and you doing work in the world. And so, somebody like Pomp, as an example, he does his podcast himself. And then after 100 episodes, it's kind of hard to ignore Pomp. He's doing good content on Twitter. He's doing good content on his podcast. If I am going to have somebody on to talk about Bitcoin, yeah, I'd love to have Pomp on. He's great. He's good at being on air. He's got strong opinions. He's educated. That's actually a better way to get press. So I think you have to look at each of these different attempts you're going to make, whether it's Facebook ads or social media, and then you have to iterate on them and learn something as a group. And it almost never works the first try out. So you have to have a certain resiliency in marketing to do 10 iterations. So we had Rachel do meetups. The meetups worked really good. Then COVID hit again. And then it inspired me to think about meetups. And we're going to relaunch the meetups. And I have a really cool format that's going to be Twist Live that we're going to start doing in the fall. And it's largely based on what Rachel learned, which is people want to hang out and meet other founders. So we're going to do a founder-only meetup. And then we're going to do one for investors as well. And we're going to cross-pollinate. So that was one of the big learnings. If you do it invite-only or people apply to come to an event, like these meetups, if it's only founders and investors, it creates like this very weird atmosphere where it's like, wait a second, everybody here is on the buy and sell side of the cap table? Ooh, interesting. I like it. So that's my best advice, is to iterate. And you look at your last experiment and you say, how could we have done that better? Anybody have any theories? Let's try the next thing. And it is super arduous and painful. So you have to accept that pain and accept that it might take you 3 to 6 months to get good at something. But if something does hit, oh my Lord, double down until you can double down no more. In my career, it happened to be podcasting. Why? Because I'm a world-class talker. And so here we are. I could talk all day long. Podcasting worked for me. Most people are terrible at podcasts. You listen to the Andreessen Horowitz podcast, it's like unlistenable. Why? Well, they're smart people, but they're just not entertaining or they're not well-spoken in most cases. So most people shouldn't do podcasts because they're not good at talking. They're good at other stuff like investing in companies or building them. So everybody followed me down this path of like, oh, if you're a VC, you have to have a podcast. You don't. You could write blog posts, or you could host a conference or a dinner, or you could host dinner parties at your house. There's other things you can do to increase your profile. You can go on CNBC. Different people are good at different things. And so really also think, what do you love to do on a marketing basis, right? Some people like to do big events. Some people like to do small events. Jeremy Allaire just invited me. He's going to do a big crypto event in San Francisco. He's like, hey, you want to moderate something? I'm going to have 3,000 people there. Like, okay, Jeremy, that sounds like an interesting opportunity. Sure, maybe I'll get involved in that. Other people might want to do a 3-person dinner or a 30-person dinner instead of a 3,000-person event. So you got to think this through yourself. What are you good at? And then are you willing to iterate on it? Great question. Okay, I think I've done a ton of questions. Okay, did you have wildcard question? Okay, Zen Profit asks, how is the electric bike effort going? This has been amazing for me. Life-changing. I have a rad power bike. That was amazing. My 12-year-old could jump on the back of it. It's got like one of those flat seats. So I got the rad power, like the crew. It's like a general bike. I don't know what the name of it is. But then I got the wagon. Now the wagon has a cage on the back where I can put my 2 6-year-olds in. So I take them down to ice cream. I got this giant like motorcycle kind of ride. Beautiful. But then I was like, you know what? I got the mountain house up in the Tahoe, Lake Tahoe area. I'm 51. I want to be in the best shape of my life this year. I lost the 40 pounds since the peak weight. I did 40 days of skiing. Now I want to use this bike. I think I want to get 20 rides in the summer. That's going to be a hard thing for me to do. I did my first one yesterday with Brian Block, who is one of the co-founders of Engadget and also the co-founder of Begin.com, a company I'm an investor in and on the board of. And we went out and I got this Turbo Levo specialized monster of an electric mountain bike. Holy cow, is it mind-blowing to go off-road, but to have this extra power. And I did like an intermediate trail and I got little mounting kisses. Like I got a scrape on my arm here. I scuffed my leg. I went down on the bike twice, not like crashes, but like I went up a big boulder and my bike went backwards. So I had to just like lay it down kind of thing, rip my leg up. It was great. And then you can go up these hills and you're outside in nature, and it actually is just like skiing. I realized those are both incredible flow experiences for me. Skiing, I put on that, I put on a little music. I got a little dad speaker I put on my jacket, and I just have Dire Straits concerts from the 80s and 90s playing, and I just zip, 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 do 2 or 3 hours skiing in the afternoon. And man, this e-bike, you're out in nature, and if you need a little extra power, you got it. So when we came back, there was this huge uphill. I just put this thing in turbo mode, zip right up the hill, and my body feels great today. I got a really hard workout, but I didn't have to destroy my body. And my friend Ryan was on a non-e-bike. He had one of those Santa Cruz non-e-bike mountain bikes, and he was wiped out on this 5 or 6 mile ride. The other interesting thing about this mountain bike is there are these crazy maniacs who make the trails. So like the trails got like bridges and I don't know what they call these swervy parts where you go up on the edge. It was awesome. I have to say, like, I literally am sitting here. I have 2 staff meetings today, but I'm on vacation. So I told everybody I'm going to, instead of taking full day vacations anymore, I take half days of work, somewhere around 12:30, like right now. Then I take the afternoon off. So this works better for me. Work the mornings, take the afternoons off. Instead of taking 2 weeks of vacation a year, take 4. But do half and half. That just personally works better for me because then I get out on the mountain, skiing or biking. I have all these amazing ideas. I have all this extra energy. So I don't like turning it off for 2 weeks. Doesn't work for me as a business owner. Doesn't work for my brain chemistry. But the half and half, ooh, yum, yum. And I am loving this specialized bike. It's super expensive. I told my chief of staff, Presh, go find the best bike. Money is no object because I'm going to be dead soon. So I made the money. I'm going to spend it on my health. That's my new view for my health. $9,000, I'm embarrassed to say, this bike cost. I was like, I could have bought a motorcycle or 2. I mean, it's kind of crazy when you think about it. But the resale value of them, goes down like $1,000 a year based on my research and what I was told. So if I use this bike for 3 years, then it's worth $5,000 or $6,000. If I use it for 3 years, $75 a month to have the best bike in the world seems quite reasonable to me. And if it makes me healthier, and it gives me joy in my life. Well, I go to dinner for $500 or $300. I can go for a bike ride. I think if I were to net it out, if I spend $1,000 a year on this and I go for 50 bike rides, it's $20 a ride. Who cares? If I go for 100 rides, if I use it casually, not just for mountain biking, but for, going to the store, which I have been using it to go for coffee, $10 a ride, well, that's what an Uber would have cost or what, owning a car would have cost. So I think e-bikes are going to change the world. I think we can reconfigure cities based on e-bikes. I am super inspired by them. I don't think it's a great investment, I'll be honest, because I think it's a dogged fight. But if you have not bought an e-bike yet, you absolutely have to go rent one. And it's a different experience because you get a workout when you want and you get transportation when you want or anything in between. So going to a dinner, I like riding it to dinner. And then I ride home and I'm like, I had a lot to eat. I had dessert, but I'm going to get 20 minutes of workout at the end, but it doesn't have to be ridiculous and I'll be sweating when I get home. It could just be like a nice little, it's like the difference between going running and going on a hike or going for a walk around town. You get to pick just by going boop, boop, boop. You just pick what mode you want to be in. It is awesome. And so I highly recommend it. Mountain biking seems to me to be pretty dangerous. And I think there's going to be a lot of injuries. So I am taking the same approach I took with skiing, which is I'm just going to do 30% less than what I'm capable of. And I'm going to keep it safe and keep myself on the road. So thanks for the question. All right. That's a lot of questions. Do we have one that's really great? Any other ones that are really great? Noah Wagman asks, when Gen Z run startup has gotten you excited from the OK Boomer segment or from your staff? A lot of them have been smaller ideas. And so I think a lot of the founders have niche ideas and then they'll open them up. And so what I like to do is meet the founders, get the energy heat check, get the, chip on your shoulder heat check. And then I like to see what their second startup is or where their pivot is. Because I think a lot of times young founders, and I'm seeing it in Gen Z and I saw it in Gen X, we start with a smaller idea, right? Something that feels safer, it's more intimate, it's personal. But then you're like, I did that. How can I make something bigger? How can I make something bigger? I'm actually been thinking about this with the podcasting. Okay, I did This Week in Startups. I created a startup that's a podcast that's 6 days a week, that have an incredible, like world-class co-host, Molly Wood, left NPR to come work with me. It's a big effing deal. And then I started another one, All In, and that became top 25 some weeks on the global charts. And it's, incredible. So now I'm like, wait, I'm pretty good at this. So I have 2 more podcasts I'm going to launch in the coming weeks. One of them is going to be kind of a roundtable format, like All In, or like when I do the All In roundtable format originated with our news roundtable. So I used to have something called the news roundtable here before I had the co-host concept with Molly. And the news roundtable would I just bring 3 people together, sometimes founders, sometimes journalists. So I'm going to launch another version of that. It's not All In. It won't be the All In guys. The All In guys, we don't have guests that often. I think we've had 3 or 4 in the history of the pod. But there are people in my orbit from the All In Summit, from This Week in Startups, who I would love to do, maybe have them in a rotating. So if you think about it, it might be like a little bit of a jam band for me, where I could have, I don't know, think of like Glenn from Redfin, who I really like, or Adina from Divvy Homes, or Brad Gerstner, or, pick people who you see me have on the show on a regular basis. Keith Raboy. There's all these other people who are like, if there's a core Avenger team of All In and This Week in Startups, me, Molly, Chamath, Sachs, and Friedberg, there's like this like really hardcore group that, are good foundational. But then I got all these other people who are like the extended X-Men universe or the extended Avengers. So the next podcast I'm going to launch is going to be a weekly roundtable, but on a specific topic. So All In is about all topics. This next one is going to be, okay, we're going to do 3 people talking about real estate, 3 people talking about crypto, 3 people with me talking about energy, right? So imagine like topical, but one topic, 3 people. What do you think of that idea? Tell me, rate it on a scale of 1 to 10. And then I've got another idea that I'm not ready to talk about yet. That'll be, well, actually, I could just say it. The We Live in the Future segment that we love doing here so much, I want to make that its own standalone show. So We Live in the Future, you guys love it so much. I would like to have Molly or myself or Friedberg or somebody go out and do on-site visits where we go to a nuclear power plant, or we go to Joby and we experience the VTOLs. And I'm thinking about We Live in the Future, which I've, got WTILF. We Live in the Future. WLITF.com. I have that, and I have the IP around it. So I'd like to either do that on TV, like a Netflix series or an HBO series with me as the host, or I'm going to I'll pay the bill myself and I'll make my own kind of go visit a cool company. So what do you think of my 2 ideas? The other one is like the roundtable. Let's call it a topical roundtable, or topic-based roundtables is idea 1. And the other one is We Live in the Future, but with like a visit to the actual place that's making the future. Which of those ideas do you like better? Which of those ideas do you like? And rate each idea on a scale of 1 to 10. I just want to see the audience reaction here. I'm going to take a look at which one you like better and what you think of my ideas. Positive, forward-looking. I'll take out a loan to help with the startup costs. Maybe some health or biotech topics. That would be great. Yeah. We Live in the Future is brilliant, encompassing J. Cal Brandt. Oh, thanks, pal. Is it a problem that not even you can get letters straight in your brain? Yes, it is. And what about an underrepresented podcast? Brandon, you should launch that. Or, yeah, I for me as a white dude to launch it, I don't know how you would feel about that. Sometimes I get criticized when I do something in diversity and inclusion, and people are like, how come the white guy's doing that? And the white male, cis white, and people start yelling at me and they call me a cis white male. And I'm like, I don't know what that means exactly. I know the white part, but, and I'm like, okay, maybe you should do that. Maybe a person of color should do that, a woman of color, somebody who's not cis, I don't know. So we need both sides of the table. Okay, let me ask you this way, Brandon. People of color version of All In or This Week in Startups. Executive produced by Jason Calacanis. How does that float? Is that opening me up to a bunch of people just totally savaging me? Or they're like, hey, J. Cal, here's a cookie and a star. You're really great. But anyway, I think, if you find out you're good at something, I think keep pulling that string. I found out I'm kind of good at creating brands like Engadget, This Week in Startups, Mahalo, Inside.com, Joystick, All In. Launch Festival, TechCrunch 50. I just like making, I also enjoy making brands. So I want to create 2 brands a year, I think, would be enough for my brain. So All In last year, Inside. This year I got the 2 new podcast ideas, and I did All In Summit. That was a new idea. Just add people of color to the already popular platforms. I do that already. Yeah, we do that already. And we actually made some progress on that with All In as well, with the summit. So, all right. Great job, everybody. That's enough show for today. Rate the show on a scale of 1 to 10. How did I do solo dolo today? We're back to the future. Remember I used to do this solo every day? It actually gets my energy going, some solos. So I think when I launch these new products, I may do a solo day once a week and let Molly do one of the other shows so she can stay focused. A 3. Okay. Well, thanks. I guess that's on a scale of 1, 2, and 3. 3 being the highest. 6, 12, 10. Okay. I'll take it. Tell me how to improve it. Great work, producers. Yeah. We were a little short-staffed today, if I'm being honest. Just Rachel, you did a great job. Rachel and Alex did a great job. I knew you could do it. Bill McCabe gives it an 11. I don't know if that's my cousin Billy. If it is my cousin Billy, we were like best friends when we were kids. We used to be really into Star Wars and starting businesses and hanging out. So love you, cousin Billy. If that is in fact my cousin Billy. If it's another Bill McCabe, it just got weird. So I love you too. It is my cousin Billy. Okay. Who's one of his kids is interning. Which of your kids is interning, cousin Billy? We got a 2-week internship for one of them. I guess he's kind of like my nephew. I don't know what you call it, a second cousin or a nephew. I guess Bobby is working here for 2 weeks, so you better give him a hard time. Make that kid work. If he doesn't cry to his dad, then I didn't do my job. So you better give him some work to do after he's done with work. Give him some homework to do after work. We got to break that kid. Okay, everybody, thanks for listening. Before I go, I wanted to let you know about the 12-week Founder University. Founder University is a program we put together to guide you through the early stages of company building. If you have an idea, you want to build an MVP, maybe you started building an MVP, you don't have to be incorporated, you don't have to have raised money, you just have to be somebody who wants to be a founder. That's why we call it Founder.University. So we're going to help you get your MVP live, maybe help you win some of your first customers, and gear up for fundraising and future growth and adding team members. This 3rd cohort, this is the 3rd time we're doing it, starts on July 11th, 2022. You go over to course.founder.university to learn more and apply, or you can just go to founder.university. I'm sure it's linked to from there. And we basically do it for free if you come to 10, 11, 12 of the 12 weeks. So if you pay the $700 to come to this class and you come to 10, 11, 12 weeks of the program, you can have an excused week or 2. You've got kids or you get sick. It's totally cool. But we want you to finish the 12 weeks. When you finish the 12 weeks, we give you the $700 back. So Stripe must think we're crazy because we have literally hundreds of thousands of dollars come in for the course, and then hundreds of thousands of dollars flow out when people finish the course. And it's just a way for you to have a little skin in the game. So I really love this program. If you can't afford it, find a friend who will give you their credit card for 12 weeks, and then you have skin in the game. So I want to see you take some risk here. But it's a great program. I spend 2 of the weeks with the folks that take pitches, and we invest $25K in typically 5 to 10 of the graduates. So it's a way for us to meet just future founders. We give them $25K at a $1 million valuation to set up their company, like 2.5% of the company for $25K. That's a great deal for us. It's a great deal for you. We take all the risk of giving you money to set up your corporation, etc. It'll be just a great time. I guarantee you're going to love it. Founder.University. And don't worry, Molly will be back tomorrow for another amazing episode of This Week in Startups. See you later. Bye-bye.